Here is the trap a lot of Australians fall into. You take a job overseas, foreign tax gets withheld from your pay, and you assume Australia's done with you. But if the ATO still treats you as an Australian tax resident, your worldwide income can be taxed here too. By the end of this video, you will know exactly how to check your status and lodge correctly. This is not a minor paperwork point. According to Country Tax Calc and Expatica, for 2025 to 2026, Australian residents are taxed on worldwide income at rates from 0 to 45%, plus the 2% Medicare levy, while non-residents get no tax-free threshold and pay 32.5% from the first dollar of Australian source income. That means the wrong assumption that foreign income sits outside your Australian return can leave you underpaying and facing a later ATO adjustment, or paying tax twice on the same money. Get the category right and the rest of your return falls into place. Here is the number this whole topic turns on. According to Country Tax Calc and Expatica, the $18,200 tax-free threshold is available to Australian residents in 2025 to 2026, but non-residents do not get it at all. So whether you are a resident or non-resident is not just a label. It can change your tax bill by thousands of dollars. Step 1 is to nail down your residency because everything else depends on it. Go to the ATO residency guidance and write down your facts honestly. Do you still have a home here? A spouse? Ongoing ties? How long have you been overseas? And do you earn any Australian source income? Match those facts to the resident and non-resident tests. According to Country Tax Calc and Expatica, getting the right category means resident equals worldwide income and non-resident means mainly Australian source income. Write the result down before you lodge anything. Step 2 is to build your evidence for the foreign income tax offset. Find the ATO FITO guidance and list every foreign income item that had tax withheld or paid, salary, dividends, rent, pensions, then collect the proof, foreign pay slips, foreign tax assessments, and withholding statements. The ATO says you can only claim the offset if you actually paid or are deemed to have paid foreign income tax, and you include that income in your Australian return. No evidence, no offset, so keep everything organised. Step 3 is conversion, and people get this wrong constantly. The ATO requires you to convert all foreign income into Australian dollars before calculating your net income. That means salary, dividends, rent, and the foreign tax you paid all need to be in AUD. Keep a clear record of the exchange rate basis you used so your figures are consistent and defensible. Good looks like every foreign figure reported in dollars with the conversion method documented. One important limit to understand on the foreign income tax offset. The ATO says the offset only goes up to the amount of Australian tax payable on that same foreign income. So if your overseas tax rate was higher, you do not get the full amount back here. The offset just stops you being taxed twice on the same income up to the Australian level. The biggest mistake people make is believing that because they pay tax overseas, they do not need to report that income in Australia at all. According to the ATO, that is wrong. It's the foreign income may still need to be included in your Australian return, and relief only comes through the foreign income tax offset when the rules are satisfied. If you simply leave the income off, you risk an ATO adjustment later, and for someone with recurring overseas salary, that mistake repeats every single year. The second common error is mishandling the offset or the currency conversion. The ATO warns that if you omit the offset or misconvert the foreign income, you can end up paying Australian tax on income already taxed overseas or underpaying and facing a later adjustment. And do not forget timing. According to Country Tax Calc and Expatica, Australians who lodge without a tax agent generally face the standard return deadline of 31st October each year. So put it in your calendar. Let us run through it fast. Step 1. Check your residency status against the ATO tests and write down the result. Step 2. Gather your foreign tax evidence so you can claim the foreign income tax offset. Step 3. Convert every foreign figure into Australian dollars and document your method. Remember, residents get the $18,200 threshold and non-residents do not. And if you self-lodge, your deadline is generally the 31st of October. If this cleared up the residency and foreign income question for you, subscribe so you do not miss the next one. We are breaking down how the foreign income tax offset actually gets calculated step by step with a worked example. Always recheck the current thresholds and rules against the ATO before you lodge, because they can change each financial year.